It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome to the Jill on Money Show. This is the program that attempts to take the mystery out of your financial life. So if something is going on, I know it's the summer, it's the late days of August. It's okay. We are here for you. If you have a question, just go to jillonmoney.com. That's our website, which you should bookmark. And in the upper right-hand corner, you can click on the Contact Us button. When you do that, a form will appear. You complete the form. And if you do not plan to come on the show with us, give us a lot of information. If you do want to appear live, then all you have to do is check the box, and Mark will do everything else. While you're on the website, we encourage you to sign up for the free weekly newsletter. It comes out every single Friday. Mark does a wonderful job of compiling all the information. And if you want to catch up with other parts of the world of Jill on Money, there are podcasts, there is a video link, there are resources, so many things right there for you. I encourage you to, again, bookmark it. You can always go back to it. Now let's get the program started with a focus on you. You guys are what makes this show. We are talking to William from New Jersey. William, welcome to the program. What can we do for you?
Hey, Jill and Mark. How you guys doing?
We're good.
Thanks for having me. First of all, before I ask my question, I just really want to say thank you guys for everything you do. I've been a listener since the pandemic, so I called back in 2021. And my question today is kind of similar to my question in 2021, but there have been some changes.
Okay.
So that's why I wanted to talk to you guys again.
I can't believe it. 2021. The time goes by so fast, William. Here we are. All right. So what's going on today? Let's forget about 2021. What do we got on your plate today?
So my wife and I, like I said, we live in New Jersey. We have 2 kids. We're relatively young. I'm 33 and she's 30. So we're not really concerned about retirement in terms of, trying to retire.
Yeah.
However, we're worried about our tax situation.
Uh-oh.
Yep.
Why? What happened? You make too much money?
It's a good problem to have, but yes.
I knew it. Okay. All right. So wait a second. How old are your kids?
3 and 2.
Okay. Are you guys both working full-time? Are both you and your wife working full-time?
Yes, we are.
How much do you guys earn together?
It's about $511,000.
Oh, my gosh. That's a good problem to have. You're so young. Incredible. Are you putting money into retirement accounts?
Yes, we both are. And this is where it gets a little bit complicated. Mm-hmm. We have a lot of retirement accounts, different options.
Yeah.
We're both contributing. And from our last call in 2021, we've really focused on the Roth. Mm-hmm. And at that time, we were making $240,000.
Oh.
So now the question is,
what should you now go to back to the traditional?
Yes. And yeah, I do have one wrinkle I want to throw out at you is we've also been lucky that we saved quite a bit as well.
Yeah.
And, before for context, right, we have about $706,000 in pre-tax
Wait a
already.
second. What is going on? Are you guys drug dealers? How are you saving so much money?
I've been working for about 12 years.
Oh, my God. You're incredible. You guys are like, this is amazing. 30-somethings, Mark. Can you believe it? And they got kids. This is amazing. The $700,000, where is that? Is that in retirement accounts or combined retirement brokerage? Where's the money allocated right now?
So the $706,000 is all pre-tax account. We have other monies, but
of course they do.
Yeah.
What else do you have?
516 of Roth accounts.
Oh my God. Okay.
And I don't think this is too important for today's question, but after tax, we have about 380.
It's insane. You guys are killing it. It's incredible. It really is.
Yes, I want to say we've been very lucky and
okay.
Working in the period where the market has
done well,
been favored.
Yeah,
done well to us. So, but the reason why I wanted to put that context out there is I'm also worried about, we already have a pretty high pre-tax balance.
Yes.
So should we, although I really focused on trying to reduce income based on, having, I saw my taxes last year, let's put it that way.
Yeah, it's rough, right? It's like a real number. And you live in a high tax state.
That's correct.
Right. So you live in New Jersey. There's a high state income tax. There's high federal tax. Do you have any money saved for the kids yet or not?
A little bit, yeah. We do have. We started 529s for them when they
You're using that.
born.
Are you using the New Jersey plan?
We decided against it because it kind of like cap you out after. We're actually using the New York plan.
Okay. All right. New York saves. That's good. Okay. The cash flow that you guys have sounds tremendous. Like, do you own a home? Are you like, where are you with all the expenses? You're just saving so much money.
We do own a home in New Jersey. Cash flow wise on a monthly basis, because we live in New Jersey, actually we spend quite a bit.
Yeah.
So we're not tight, but at the same time, money is not just, because we're saving a lot in accounts and the options of accounts we have, that we just don't have, free cash all the time.
Right.
Sometimes it does come through, but not all the time.
But you're saving a lot of money anyway. You're putting money into your retirement accounts, and then you've got this other money. So I understand that it doesn't feel like you have a lot of cash flow, but you are. That includes the fact that you're saving so much. How much is your house worth?
Actually, I don't know. Maybe 600.
Is there a mortgage on it?
Yes, we still have a 350 balance on that mortgage.
What's the interest rate?
Oh, yeah. Mark, close your ears on this one.
Oh, yeah. Here we go.
2.75.
Okay. I like how everyone Mark is now. They're attuned to like, Mark, brace yourself, man. So is the basic question at this point, because you've got a lot of money, is the basic question, should you basically go back to a pre-tax retirement contribution because your tax bracket has gone up substantially? Is that the basic question?
That is the basic question, yes. And I also am asking that question from the context of a lot of what I'm learning as of last year was that you qualify for a lot of credits and deductions based on your income. For our income being so high, should we be worried about reducing it to qualify for those credits?
Yeah, you're not going to. But how are you going to qualify for those credits? What are you going to do? Like, oh, I don't think I'll work as much because, can you control your income right now?
So I guess maybe what I meant by was, for example, if we switch over to all pre-tax accounts, we could go from 511 and we could contribute and, be below 400 grand of
you mean to get like the child tax credit and have those various little benefits that flow. We'll get back to William in just a moment. If you've got a question about using a Roth, or maybe you're contemplating some sort of real estate transaction, maybe you're going to buy a home, maybe you're going to sell your home, anything that remotely touches a dollar, then we are here to help you out. Both Mark and I are certified financial planners, and we love answering your questions. Go to JillOnMoney.com and click the Contact Us button. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
Welcome back. It's the Jill on Money Show. We are here trying to mentor, coach, prop you up, help you along your financial journey, whatever is going on. If you've got a question, just go to our website, JillOnMoney.com. Click the Contact Us button, write us a note, and if you'd like to join us live, check the box. Mark will do everything else. Hey, while you're on the website, check out our subscription service. It's called Jill on Money Live. This is where you have access to quarterly live webinars, 4 of them quarterly, for the next 12 months. You'll also have the entire back catalog of those webinars, and there's bonus audio and video content. And coming up on September 10th, we have a webinar devoted to estate planning. I know you've been thinking about it. I know you're trying to convince your parents to do it or your young adult children to do it. Whatever is going on the estate front, we're covering it. That's the next webinar, but you must be a member of Jill on Money Live to participate. Okay, so check that out. Right now, let's get back to William from New Jersey. Mark, what are you thinking about William and his wife? I mean, first of all, the cash flow king and queen of New Jersey. And the saving extraordinary, right? But what do you think? Their income is basically doubled. And
I don't really need to think. I mean,
oh boy, here we go.
No, I mean, I always like to try and relate it to myself. And William, I live in New York, very high cost of living. We're in the same tax bracket as you. I don't even think twice. We don't do $1 to pre-tax. Everything is Roth or brokerage, and that's it. Because as Ed Slott always likes to say, you guys are high earners. It's highly unlikely you're not going to be high earners going forward. You already have almost $1 million in pre-tax. That's just going to continue to grow. So it's not even a decision to be made. It would be all Roth or brokerage for me.
Now, William, I know that's a bitter pill to swallow, but there is something to be said for also knowing that the tax liability is not going to compound, right? I mean, like Mark said, you already have $700,000, right? That's in the pre-tax environment. So right. The idea of adding to that, oh gosh, and by the time you guys are like in your mid 30s, you have $1 million pre-tax. It's just getting bigger and bigger and bigger. What another thing that Ed Slott likes to talk about, and for those of you who haven't listened to Ed Slott, he is fantastic. He talks about the ticking tax bomb. What you're describing is actually feels better in the moment because you're like, my taxes go down. And yet we have this long fuse for that ticking tax bomb. And if we allow it to just fester, it will go off. It will go off. You will have to pay that. It's just that you're kicking the can down the road. So weirdly, even though you make a $500,000 a year. And, listen, most of your money is taxed in like the 32% bracket. But by the way, that 24% bracket's pretty broad. So, you're still in a bracket where you are, you're most likely going to stay there. I don't see a world where you're making that kind of money and saving that kind of money where you're not going to actually end up being even in the 35% bracket, in the 37% bracket. When we really crunch these numbers, and even with people who are in a high tax bracket, the highest tax bracket, we are also seeing the case to be made for a Roth. Because when is your tax bracket going to go down? You have money in brokerage, you're earners, you're going to keep making money. It's very unlikely that tax bracket's going down, man.
Yeah. And Mark, thanks for your perspective. I think one of the things that made me ask this question again really was the recent, let's call it the tax bill that got passed.
Yeah, the big, beautiful bill.
That's right. Should I really be fussing around trying to qualify for things, with the new salt tax minimums and all that other stuff, right? Or should I just say, you know what? Bite the bullet, pay the tax now, forget about all those future deductions. And that's what I meant by deductions.
I know what you mean, because the limitation on the salt tax, by the way, that's only in place for 3 years, and it goes back to 10,000. That tax is a drag. I get it. I'd rather you be more tax efficient with like your brokerage account, maybe slide some of that brokerage account money into the 529, which makes it a much more efficient way to invest. Limit that. I don't know if I would play this game. Mark, he makes a case, right? Like if he could get himself down under 400, which I don't know if you really can, because it depends really how much money you're making and where all your itemized deductions are. I mean, what you could also do is you can see how this tax year goes. Do you work with an accountant or you do it yourself?
I probably should work with an accountant.
Probably.
But
you might as well.
yeah.
You could interview an accountant and you can say to the accountant, here's here's what I think I have. Do you think what they can look at is really, are you going to be entitled to? Because I'd hate for you to go through this whole process and they're like, guess what? You got phased out anyway.
What are your property taxes? Do you know?
Yes, about $11K.
No, then forget it.
Oh my God.
You're going to do all this for another $1,000?
I guess here's the question, right? In terms of me reducing my income, my wife has access to three, because she works for the state. Mm-hmm. She has access to a 401A, a 457, and a 403B.
Right. And you're putting money in all of them?
We're putting money in all of them, and currently all Roth, right? So, And then on my end, I have access to my 401K. So all combined.
Okay, wait. I'm going to do a thought experiment with you. You ready? What if you went to a CPA and you said, do me a favor. If I did all this, tell me my actual tax position, how it would, you can have a dummy tax return done. Like, you should hire someone. You guys have a lot going on, but okay. So like, what if it's like, we're talking, because remember, SALT is a state and local tax deduction. We're not talking about you qualifying for credits because you're not going to get any credits. You're talking about that your state and local tax deduction will be limited to $40,000. I agree with Mark. Like if that is what we're talking about, you can literally find out how much money we're talking about. And if you found out that the ultimate difference in your tax bill was like $3,000, right? Just because it's a deduction. Again, it's not a credit. You might say, what am I making myself crazy for? The bigger problem is going to be this $700,000 that's building up. That's all of a sudden going to be $1 million in a couple of years. And now I'm talking about real money, by the way, because now I'm talking about, well, what if I'm in the 40% tax bracket when I retire? And I'm quibbling about this.
Okay.
Do you know what I mean? Like we might be like looking to save a few bucks now, but the long-term impact of having that money compound and grow is significant. Have you ever heard us talk on the show when we're talking to somebody and they're like, I want to reduce my income because I want to not pay that extra fee when I get Medicare, that IRMA fee. We're like, what are you talking about? This is $5,000 a year. And you're talking about that you got millions of dollars. You're concentrating on the wrong thing. And so I think this may be your case, William, where you are focusing on this. I get it. It's very much a tantalizing lure. You had something, you lost something, but now you're making so much money, you don't even realize it. You don't realize how big this problem is going to get. I really think that you're in great shape. Maybe go talk to an accountant, even an accountant. Accountants sometimes are dopes also because they'll be like, oh, no, you can save taxes today. And you say, well, what about the future? Oh, we'll deal with that in the future. This is not something you can deal with in the future. This is a ticking tax bomb. There's no doubt in my mind.
No, this is good to hear, Jill and Mark, because I actually do not want to major in the minors.
Yeah.
That's not my goal. I kind of, like I said, I've put it off. We continue to do Roth. And this only came about because it's like I actually had to write a check last year. So I was like, should I actually reconsider this typically?
I think it's good to reconsider anything. I really do. But I think you're in great shape. I wouldn't change a thing. And Mark, would you like to have the last word?
Not $1 to pre-tax. That's my last word.
Hear that? Not $1 to pre-tax, William. Got a financial question? Just go to JillOnMoney.com and click the Contact Us button. You're listening to Jill on Money. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
Welcome back. It's the Jill on Money Show. We're answering your financial questions. So if you have one, just go to JillOnMoney.com and click the Contact Us button. Write us that note, and if you'd like to join us live, check the box. We'll do everything else. I mean, Mark will do everything else because he's running the show here. Come on, let's be honest. Right now, let's talk to Gary, who joins us from the Pacific Northwest. And Gary, you get an award. You get 5 stars for sticking with us, man. And I know we had a hard time getting you on the air last week, and here we are today. So how are you? And thank you so much for your patience with us.
Oh, we're good. I just appreciate Mark's patience with
Oh, he's the best, isn't he?
helping me.
Yeah, he's great. What's going on? How can we help you out?
I would like to retire in a month. I just finally had enough. And
what made you, wait a second, what was the enough? Like, what was it? Was there a moment in time where you just like, I am exhausted? Like, what was it for you?
Physically and mentally worn out.
Mm-hmm.
And I don't feel like I can keep going. So my question is, I found a financial advisor, and I've been working with them since May, and they put a plan together. I just wanted to run by you and see if it sounds kosher.
Okay, I like it. I like the idea that like you're already out, you're done. So how old are you, Gary?
Well, I'm not done yet, but I'm 62.
And you'd like to say, I want to retire in a month. So you're like, you've done, you've put up with enough. Let's see if we can make this happen. What does the advisor say? Did they do a plan that showed you could do it?
Yeah, they asked me, what our monthly budget is, and I told them, and yeah, I think it's doable.
Mm-hmm.
My wife is will still be working.
Oh, that makes it a lot easier. How much does she make right now?
Closer to 60.
Mm-hmm. Can you live on her salary alone, do you think, or not?
No.
Okay. How old is she?
She's 57.
How much money do you think you need when you look at your expenses? Like, what do you think you need to live on? What's the spend that you need?
About $6,000
a month. Okay. Yeah. I gotcha. And she has it's not $5,000 because I'm sure there are things that come out of that. Will you continue? So would you receive health insurance on her plan? Is that the game plan for you guys?
Yes.
Okay. So she would carry you on her health insurance. So that's good. She would, obviously create a bunch of the money that you need for the expenses to cover those expenses. How long do you think she would like to work?
Well, so the plan, we've decided to move in a few years, and that's one of the reasons why I wanted to retire, so I could start planning out and getting the house ready to put on the market and all that.
Okay. How much is the house worth?
$800 to $840.
All right. Is there a mortgage that remains?
Oh yeah.
Oh yeah. How much is the mortgage? What's left?
So we have a first, which is $460, and we have a second, which is like $60.
What's the interest rate on the $460?
We got it pretty low. It's 3.2.
Good. And what about the $60? That's probably variable. Is that right?
No, it's fixed. It's also low. It's like around 3.
Oh my God. For a second. That's amazing. But we're moving always sounds like a great idea. Are you thinking about moving to someplace like much cheaper? Like, what do you think?
Well, we're thinking moving abroad.
Oh, okay. And would it be more or less expensive, do you think?
We just kind of started this process, but it would be much cheaper.
Much cheaper. So
yeah, probably like half of what our monthly expenses are right now.
Really? Okay. But would you buy or would you rent someplace?
In the beginning, we would rent and
see how you like it, right?
Yeah,
Do you guys have kids, grown kids? What's going on?
We have 2 grown kids. Yeah, one is 24 and the other one is 30.
Are they okay and on their own?
Yes, they're on their own. One of them needs a little help.
A little, but not like some major amount of ongoing support, right?
No.
Okay. What have you guys, besides the house where you have a nice big chunk of equity, what have you guys saved to make this happen? Like you have a retirement plan at work right now. How much money is in there?
So there's a DCP plan which I have 37,000. Then there is a PERS 3 plan, which I have 340,000.
Okay. So you'll be entitled to a pension. Is that right?
Yes.
What will that pension amount be?
Around 1,800.
So that's pretty good, though. If your wife's going to keep working for a few years and she is making 60 grand, and then you've got 1,800 a month from your pension, her income plus that pension should not exactly, but pretty close to cover your needs, right? Your expenses. So that's good. And then you've got this other pot of money. Does she also have a retirement account?
Yeah, she has a Fidelity 403B through her work, which has like 56,000 in there.
What's the actual issue that you are inquiring about? You hire this financial person, they do a plan. What is the plan? What is the recommendation of the plan that I think you're seeking a blessing of? What do they say they want to do?
So they want to pull all the money together, and they made this plan, which has different buckets in it, like 1 year, 3 year, 5 year, 7 year, 10, and 20, I believe. And so they split up our money into these buckets, and
I'm going to guess they think you should buy an annuity.
Well, I think one of them will be annuity. The other, some of the insurance products.
We'll get back to Gary in just a minute. If something is going on in your life, maybe you're changing jobs, maybe you're thinking about retirement, maybe you want to put your kids through college and you need some assistance, get in touch with us. Go to JillOnMoney.com, and in the upper right-hand corner, there is a Contact Us button. Click that button, write us a note, and check that box if you want to join us on the air. You're listening to Jill on Money.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
Welcome back. It's the Jill on Money Show. We are answering your questions, and really the questions can be far-ranging, whatever is impacting your finances, your personal life, your career life, whatever it is, get in touch with us. Go to JillOnMoney.com, click the Contact Us button, write us a note, and of course, check the box if you'd like to join us live. I love the emails that we receive, but it's so helpful when you come on the air with us because we can ask you those follow-up questions, and so that's really a fruitful experience for both of us. So I hope that you get over whatever fear you have and just join us. We can change your name and your location. Don't worry. Right now, let's get back to Gary from the Pacific Northwest.
So the plan 1, 2, 3, 4, 5, it has a protected principal. These are protected principal accounts, and so you earn interest on it, but obviously your principal is protected.
I am concerned that if you took all of this advice and put it to work, that you're tying up a lot of your money. I know that they have the 1, 3, 5 and everything, but all these things cost money. And I think that this might be overkill for what your needs are, because it sounds to me, it's so funny, like the basic facts seem like they line up okay, meaning your wife works for a few more years, you got that pension, that money is the money you'll need to live on. Do you have any money in savings besides the retirement accounts that you and your wife maintain? Is there a bank or a savings account that you have?
Yeah, we have about 7,000 in savings.
That's it.
Yeah.
So I'm a little concerned that if you tie up all this money, we lose access to it. And you may need this money to do different things. I don't know if I want there to be an annuity. I am more inclined to have this money available to you and then maybe see what happens after you sell the house and you move abroad. But I think you're going to want to have access to your money. I'm not saying this person's trying to screw you. I'm just saying that what I would be more interested in finding out is, okay, that's one plan. What would a plan look like if we just actually did not have we didn't have these products. We didn't have a protected principal account, but we had some money that was in a retirement account that we manage or you manage, and it's accessible to us. We're a little uncomfortable tying up our money because we kind of don't know where life is going to lead us. And especially with this move abroad. And I would seek another alternative. And I know that may sound like kind of a pain in the butt, but I think it's important that people look forward, especially because you guys are both so young. She's 57, you're 62. You don't know what's going to happen. You don't know how life's going to roll. You might need $50,000. And if it's sitting in some sort of structured account, then I don't think that that's going to serve you well. So I think what I would do is I would be very careful about moving forward with them. I don't want to make you, again, I'm not going to tell you that this person is necessarily ripping you off or they're this, that, and the other thing. I might get a second opinion. I might go to someone who's a certified financial planner and say, what do you think of this plan? And see what they say. I think that you guys need to be a little bit more careful about tying up your money. I know that there are a lot of advisors, people with radio shows, people who deal with people who have state pensions, people who deal with teachers or these hospitals. They tend to be very product heavy. They lean on the sale of products. And I would just be a little bit cautious before I dumped the money into those products. Does that make sense to you, Gary?
It does, but I have to mention that there will be access to the funds from these protected plans, and they set aside emergency cash fund of $45,000 out of that, and so there is access.
Okay, as long as there's some access, I still would say to them, what if I didn't want to do this? I don't want to sink $200,000 into this. What's my alternative? Ask that question. That is the question to ask. Because without the answer to that question, I do feel like they're pushing this product, and I am concerned that that is good for them and may not be so good for you. I would get a second opinion. That's all I'm going to tell you. And I think that, you sound like you're in a good place generally, but I would get a second opinion from someone not involved in this company at all. That's what I would do. And if you think that that's, when I see things that are structured and products and annuities, that is a bit of that's a warning to me. Okay. That's a warning. It doesn't mean it's the worst thing in the world, but not every single problem needs a solution that's called an insurance product. So in my mind, even though there may be some money that's liquid, I just would like to have someone else's eyes on the situation. And I know that you want to believe that everything's on the up and up. Maybe it is, but it's like a doctor. You want to get a second opinion. And so that's my advice to you, that it sounds good, but we want some confirmation. Okay. And if you can get some confirmation and someone else says, yeah, that's a cool plan, fine. But I wouldn't go through with it right away until I had some more confirmation. You're listening to the Jill on Money Show. We'll be right back. Welcome back. It's the Jill on Money Show. We are here answering your financial questions. If you have one, all you need to do is go to our website. Our website is jillonmoney.com. While you're on the website, you will see that you can subscribe to 2 other audio shows, 2 podcasts, as a matter of fact. One is called Jill on Money. It airs Monday through Friday, and the other is Money Watch, which is our weekend show. Both of them are kind of little nuggets, 15, 20 minutes maybe. Not a huge investment, but it is similar to this program, little bite-sized portions of it. So check it out. You can subscribe to either Jill on Money or Money Watch or both on the Odyssey app or wherever you get your favorite podcasts. If you don't get into podcasts yet, again, just go to the website and you can follow the links. Right now, let's get to an email. This is from Adrian, who writes, "My wife and I are in our 50s and we've worked with a financial planner for decades. The reason? Because we're financial novices and we're busy teachers. Managing our financial portfolio just seems so overwhelming. The financial planner charges 1% of fees on our total portfolio, but it just dawned on us that we're paying 10 grand a year to have him manage our portfolio, which is basically performing at the market average. We're starting to consider switching to a self-managed account at the same firm instead of continuing to use his services. As I said, we are financial novices, so we're scared of mismanaging the account or losing money. We're trying to decide if this $10,000 fee is worth the security of having him manage the account, or can we do it on our own using tools available online?" Adrian, this is a great question. I think paying the fee is not so bad, but it seems like you should be getting more for that 1%. In other words, does the planner actually walk through a financial plan with you? Does he update it on an annual basis? Do you feel like you are comfortable with this person asking about different aspects of your own financial life? If that's the case, then yes, 1% is worth it. But I'd encourage you to check out other options, maybe with a different firm where you might get more robust services. I hope that helps. Okay, we've got a whole nother hour to go. You're listening to the Jill on Money Show, and we will be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome back. It's hour number 2 of the Jill on Money Show, and we are here trying to help you navigate your financial journey. There are obviously many different routes that you can take. Our goal is to identify those and help you decide which might be the best for you. If you've got a financial question, just go to jillonmoney.com and click the Contact Us button. Right now, let's talk to Jean, who joins us from Texas. Hi, Jean. How are you?
I'm good. How are you?
Great. What's going on? How can we help you out?
So, I've been listening for a long time, and I've said since a year ago, I'm going to write in and do this. And it really is easy. I didn't believe how easy. And the reply was before I could turn around.
Yes, Mark. That's right. Mark's the best. So what prompted the outbound reach to us?
Thinking I'm in my early 50s, thinking about long-term care, had a father that helped through hospice, and an aging mother, and now I'm thinking about, is that me? In 8 years, I have no children. I'm single, and I'm thinking reaching out to these companies to assess costs for long-term care, and it's pretty outrageous.
Yes. Oh my God, Jean, I'm not kidding when I say that. Like I remember looking at long-term care when I was a financial advisor, which is now basically 20 years ago. Okay, so it's been a long time. But I remember we would look for policies, and you could find there were a lot of insurance companies that were in the long-term care business. But what ended up happening was that a lot of those companies mispriced the risk of long-term care. for the same reason that you are looking at long-term care right now, those companies got out of the business of long-term care.
Mhm.
So what we know is, and you're experiencing this firsthand, the care is more expensive, and costs keep going up. People are living longer, and
Mhm.
women especially. It is true. This is more of a woman issue, and statistically, we tend to be sicker in our lives and men die sooner. So that's the difference between morbidity and mortality.
Mhm.
And it's the real crux of the matter with long-term care. There aren't a lot of providers. It's really expensive, and it's hard for these companies to quantify that risk. So, Jean, let's figure
Yeah.
out actually if you need long-term care insurance,
Okay.
because
Okay.
it is expensive. But I know your experience with your parents makes you very sensitive to it, right?
Yes, very.
I got you. Okay. So you're in your early 50s. You say no
Mhm.
kids. You're single. Are you working full time?
Yes.
Okay. How much do you earn?
About 110.
Great. And do you have a retirement plan through work?
Yes, I do.
What is in that retirement plan in terms of the amount, not the actual assets or the investments?
Oh, well, the number I wrote down is the future monthly amount, which would be
Oh, wait.
10.
Do you have a pension?
Yes,
Oh, okay. So the pension, what will your pension be?
$5,080.
$5,080 a month. At what age does that start, Jean?
It's in 5 years, but I'm holding out for a retirement incentive that
Okay.
it's going to be a lump sum.
So that would mean you'd have to hold on till age 62, right?
Yes.
Okay. So we got 10 years to go, and it'll be about $5,000 a month. Now, with that pension, is there a cost of living adjustment? Is there an inflation increase every year?
There was 2 years ago, and that had
Mhm.
never been done. So it's pretty rare.
Okay. All right. Now, do you save money besides the pension? Do you put money away in any sort of deferred comp or an IRA or a Roth IRA?
A Roth 403B, I'm
Uh-huh.
maxing that out every
Oh,
year.
oh my gosh. How much is in there?
About 102. But
Great.
I feel like I started late. I should have done
Well,
that, but
but you're
that's
maxing
everyone.
out. Yeah, but you're maxing out now. So that's great. Fantastic. Any other money that you have set aside savings wise or investing or other anything else that I would include with how I would think about you financing long-term care if you needed it?
So I have a Roth 162 800, and
I'm going to
then
call it 163. Don't be mad. Okay.
okay.
Roth 163. Okay.
And then I have brokerage about 125.
Great. That's fantastic. Money in the bank, savings, checking, CDs, anything boring like that out there?
Yeah, about 22 just in a CD,
Okay.
and then savings is about 4,000.
Now you make 110,000. You said you max out your Roth 403b, right?
Yes,
You're putting money away in your brokerage and your savings. Like you're definitely saving money. Do you have an idea how much your expenses are right now?
3,000, and
Oh,
that's
that's
on
what
the high end.
really. Okay. So essentially what you're saying to me is, hey, if you never got sick a day in your life, God willing, right? That 5,000 a month is going to cover your needs, not even a question, even before you claim Social Security, right?
I'm relieved to hear that from an expert.
Yeah. I mean, it does it, if your expenses are $3,000 a month now, I mean, in 10 years, I'm pretending you're 52, you said early 50s. In 10 years, when you're 62, you've got this $5,000 a month. Those expenses grow over the next 10 years, there is inflation applied, but it's not going to be more. But then the money you get from your pension should basically cover your expenses. And that doesn't even include Social Security. How is your health currently?
I'm good. I'm just a former athlete, so my knees, my hip kind of situation. So
Dude, me
the
too.
bottom half of me is going to be a robot.
Me too. I'm with you. What sport did you play? What's your aging athleticism?
Anything at the gym. If it didn't hurt, then it wasn't worth doing.
Oh my God. This is how, you know what I say? I have a very dear friend of mine. She played squash in college. I played soccer and lacrosse. And I say to her, I said, all of our friends who sat in the dorm and like smoked pot and partied their butts off for 4 years, their bodies are in great shape. We are breaking down, like day by day, breaking down. Okay. So you're in good shape. Are you planning to take Social Security at 67? Is that the game plan for you?
It depends. So far, I look at the longevity of my both sides of the house here, and yeah, I think I'm going to surpass. Have a mother. She's about to turn 85, and she's sharp. Nothing passes her. Her memory's sharp.
Do you know what your Social Security benefit looks like either at 67 or 70?
I do. 3,367, and then at 74,300.
I mean, there's no problems here. Really no problems. When you retire, what happens for you healthcare wise?
We've got an option that we pay out of pocket $200 to continue.
That's it? You're in good shape. Okay, this is great. We'll get back to Jean in just a minute. If you have something going on in your life and it remotely touches a dollar bill, let us know how we can help you out. Just go to JillOnMoney.com and click the Contact Us button. If you want to join us live, check the box. Mark will do everything else. You are listening to the Jill on Money Show, and we will be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
Welcome back. It's the Jill on Money Show. We are here answering your financial questions. Right now, let's get back to Jean from Texas. Now, let's play devil's advocate for a second, okay?
Please.
You look at your life and you say, I've got the money I need. Jill says I'm cool. Let's just even pretend that by, the time you're 67, you've got like $8,300, $8,400 a month in expenses. Hey, Mark, can you just do me a quick calculation of $3,000 a month? Can you inflate that for 15 years at a 3.5% inflation rate? So $3,000 a month in 15 years is going to be what is the dollar amount in 15 years? Future value?
Roughly like 5,100.
Okay. So 5,100. So now here's what you can think about, Jean. Let's pretend your pension doesn't really move, but it will a little bit. But let's just say you've got $5,100 a month from your pension. Then you have $3,300 a month from your Social Security, and your future expenses are about $5,100 or $5,000 a month. You got plenty of money to cover you.
Oh, no, yeah. Oh, yeah. She's got $1 million in assets.
What do you mean $1 million in assets? How did you figure that?
What she has right now, what does she have, 300 and something thousand?
I see what you did. Okay. So I was like, what do you mean? So then what Mark also did was he took the $100,000 in the Roth 403B, the $163 in the Roth IRA, the $125 in the brokerage account. He took that, $390,000. And then what he did was he presumed that it earned some modest rate of return.
And I assume that she continues to max out.
And that you max out until you're 62. And all of a sudden, there's $1 million also in the kitty. Okay?
What?
Yeah.
Those people?
Yeah, you are. You're a millionaire. Sorry, babe.
No, a jillionaire.
You're a jillionaire, as we like to say on this show. So that's how compounding works, gang. It's incredible. It really is, right? So one of the things but while you're calling is, well, what happens if I need long-term care? So there's something that's interesting in your situation. Okay. Let's say that you did need care. Okay. You own a home?
No.
You rent?
Not to. Yes. I prefer that because it's just me. And
okay.
Yeah.
Okay. So how much is your rent?
$575.
A month. $575 a month. Okay. So what would happen if you needed care? Well, there's two different things. One is like, do I need care in my apartment? Do I need to pay someone to come in and take care of me? Do I need to be in a facility? Let's pretend you needed to go to a facility because that's usually the bigger expense, right?
Right, right.
Okay. So you say, do you have siblings?
Yes, older brother.
Older brother. I don't want to be a burden to my older brother, nieces or nephews or anything like that. What would happen? Okay, you'd go into a facility and it would cost money, right? But you would still be getting that $8,000 a month. You would be able to pay for care and to be in a facility of some sort. Now, it may be that you'd have to spend down some of your $1 million at the time, but it's highly unlikely you would spend all of it down. And it's just you. What if you did spend it all down? What if you spent it all down and you could then basically ride out whatever long-term care would come about? Now, of course, given the current changes to Medicaid, I can't say this with like absolute certainty, but there will be some sort of program for Medicaid where we have nursing care. It'll probably be tested in some way. So you'll probably have to spend down a bunch of your money, but chances are you're going to be covered. So the question that you come on the program asking, do I need long-term care insurance? Should you buy that coverage? I'm leaning towards no. Mark, are you also leaning towards no?
Yeah, absolutely. Just given the guaranteed income that's going to be coming in and the low expenses right now and the fact that it's just her by herself. Yeah, I don't see a need.
When we would think about long-term care, Jean, would be if you were partnered, okay? And now let's just pretend it's the exact same scenario. And you're like, I have a wife, I have a husband, I have someone who's relying on me. And it's the exact same scenario where the two of you as a couple have, instead of maybe $8,000 a month, maybe it's $10,000 a month. Okay. And it's $1 million that you will have saved. If one person were to get sick and go through the $1 million, that could leave the surviving and healthy spouse in a precarious situation. And that's when we start to think maybe there's some sort of insurance product. It may not even be long-term care. Maybe it is a hybrid product where there's some long-term care. We take some of the money and we pop it into some sort of an annuity or life insurance product that has a long-term care rider. And that might be something worth considering. But because it's just you, I don't think you need to do this. I'm just wondering about your mom. So tell me, you said she's sharp as a tack. Is she living on her own?
She actually lives with my brother, but she could live alone. She just doesn't drive. We joke that we're going to get her one of those self-driving cars. Then she'd never.
Oh, yes. Did your father's passing leave her with some money or not really?
Yes, my father's pension, and she's got Social Security, so she's independent.
Okay. That's great. I don't think you have anything to worry about here. I really don't. I think that, listen, if you call me back in a month and say, I hate my job and I have a new boss and I'm done, that might be that's a different situation. But given the facts that you have laid out, seems to me that buying long-term care insurance would be an extra expense that is probably not worth it for you.
I have one more question. So,
okay.
The retirement incentive.
Yeah, tell me about that.
That they're like, man, Uncle Sam took a majority of it. And I was thinking, since I like to listen to these podcasts, I'm like, you should have had an IRA. You should. Yeah. I was thinking to myself, I was trying to be you. I'm like, if I were Jill, I would have recommended. But I researched it and I'm like, well, if once I'm there, I'm going to have the deer in the headlight look. What do I do? What's the proper way to take care of that money?
Well, it depends. The money that is given as part of a retirement incentive is often given in a lump sum, right? And what they're complaining about with everybody, I love when people complain that they make money. What they're complaining about is, I got this chunk of money and holy smokes, I was taxed on it. So what do you think? Give me an idea of what you think your lump sum might be. Just give us a ballpark and I'll give you the example.
Let's do 80.
Okay. So you make 110, all right, right now, which means as a single filer, you pay a bunch of tax at the 12% rate and a bunch of tax at the 22% rate. If we now assume you were to get 100, if you were then on top of your 110, get an $80,000 extra incentive bonus, now that 80,000 is on top of the 110, and it means that you've crept up into a tax bracket of 24% on that extra money. So what they're probably reacting to is, Uncle Sam took a quarter of my money. No kidding. You just had a big chunk of money, as instead of paying tax along the way for another year, you just got it in one lump sum. And that's what you're paying tax on. You cannot make that money go away, by the way. There is no magical way to not pay tax on that. But what you can do is whatever your tax is for you, if you got that 80 grand, and you hopefully we'll be here, God willing, in 10 years when you're doing this. If you got the 80 grand, you give us a holler and you say, okay, well, my 80 is now 55. What do I do? And I say, put in the brokerage account, keep putting your money away, keep investing it. Don't mess with it. That's wonderful. Good for you. That's it. Unless you needed a chunk of money up front for something, unless you said, well, I've cleared 55,000, but I need a new car. Okay, so buy a new car with it. But it's a good problem to have, Gene. It really is. That's why I laugh about these people. Oh, I have to pay so much tax. Okay, let's pretend you don't have to pay tax and you don't get the money either. Is that better? I don't think so. Do you? It's not good. No. If you've got a financial question, just go to JillOnMoney.com and click the Contact Us button. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
Welcome back. It's the Jill on Money Show, and I know it is towards the end of August. Some of you may be on vacation. Maybe you're driving somewhere fabulous. Maybe you're thinking, well, why do I want to think about my financial life right now? Well, I found that sometimes when you're on vacation or you have a little bit of a break, there's enough space for you to consider different things that you'd like to do. Maybe that vacation could be a longer vacation if you had a different job. And maybe if you had a different job that paid a little bit less money, you could work longer. Or maybe you're thinking about the fact that this vacation is so short and I'm tied to my job and that feels really bad. Whatever the circumstance is, if you think you'd like some guidance about how to change the conditions that you are now operating under, give us a holler. Go to JillOnMoney.com and click the Contact Us button. And I would encourage you to consider joining us on the air live, because then we can walk through different options and you can ask follow-up questions and we can ask follow-up questions. So I think it's really helpful. Right now, let's talk to Mike, who joins us from Chicago. Hi, Mike. How are you?
Hi, Jill. I'm very good. Thank you.
What brings you to us?
I've been listening to your podcast for a couple of weeks straight now, and I just had some questions about upcoming retirement, like most people do. I'm 60 years old. The plan is to work till about 67. I'm a teacher. At 67, I was going to take Social Security, which would be about $2,600 a month. I also have a small frozen pension from about 20 years ago that'll pay me about $460 a month, starting at 65. And I have a fixed index annuity with an income rider that will pay me about $2,200 a month. If I were to take payments at 67. So the whole plan is to work to 67.
Okay, wait, just give me that. Fixed index was $2,200 a month, $2,600 a month from Social Security, the $460 a month from the frozen pension. That's kicks in at 65. How much do you earn right now, Mike?
About $57,000 a year.
And are you single, married, partnered?
I'm single.
Okay. Kids, no kids?
No kids.
Okay. So we're just talking about the world of Mike and what you can, right? Okay, very good. So how does it seem when you think about these numbers? How does it look for you in terms of your expenses? Like, do you think this kind of covers your basic needs, this amount of money?
Yeah. I mean, other than the wild card of health, this is probably I count about $5,200 a month that's guaranteed for life. That's probably more than I bring in right now.
Right. And the Social Security will be indexed for inflation. The
Right.
pension, is that a straight line? That doesn't have a cost of living adjustment, does it?
It does not, and nor does the annuity.
Okay. So, yeah, I mean, I guess we have to look at your future costs would be rising. But have you saved any other money to be able to fund that gap later in life?
Yeah, so I have a 403B through school, which is right now at $170,000, and I'm still contributing to it, and they also match 2%.
And that's all pre-tax, has not yet been taxed, right?
Correct.
So that's traditional. Okay.
And
What
then
else?
I have a Roth with $130,000 in it that I also contribute $300 a month to, and I plan to continue doing that as well.
Great. I mean, you're putting money into the 403B. You're putting the money into the Roth. I mean, what are your actual expenses, do you think?
Currently, I mean, my condo is paid for. I mean, I've got a car payment about $270 a month. I mean, other than that, it's just, the normal utilities and day-to-day expenses for my credit card, but I pay it off at the end of each month. So I don't have any lasting debt there.
You think it's like $3,000 a month, maybe?
Yeah, I would say that's about.
I mean, you have condo fees and stuff, but like maybe like, did you travel at all or not really?
Nothing super far. No, I'm not a big traveler.
I mean, this sounds like this sounds like a very good situation. How much is the condo worth?
It's small, probably $120,000, and it's paid for.
Okay.
There was a thought that maybe 4 or 5 years down the road, I might look for something just a little bit bigger in a little bit different neighborhood. I'm not sure about that, but if I can get enough for this and be able to pay for the rest out of my Roth and not have a mortgage, that's something that I've thought about.
I don't know if I'd want to pay it out of the Roth. I like that Roth being there for you because the money that you've put into the 403B, it hasn't been taxed yet. You're going to have to take it out. Maybe I would even tap that, sooner rather than later. You're using a traditional, is there a Roth option at work or not?
They just started offering a 403 Roth. I mean, like very, very, like within the last year or two. And I haven't looked into how that would work with my current 403B.
Here's what I would suggest. Let's look into that. And if they say, oh, well, you have to put some money in the traditional to get our match, put whatever you can put into the traditional, leave it at that. And then anything extra, then put into the Roth. Because we're going to have to tap that 403B eventually anyway.
Well, that's kind of what I've been doing. I used to take a bigger chunk of my personal and put it into my 403B. What I've done now is I've lowered my 403B contribution just to what I need to get the match. And I've taken all of that perceived extra money, and that's what I'm putting into my personal Roth. I'm trying to get it more balanced by the time I turn 67.
That's perfect.
But am I in a spot where I want to start making the conversions, or am I?
No. There's no need to make the conversion. I don't want you to. If anything, the only thing that would happen is when you retire. Okay, when you're okay, I'm 67. You're done teaching, right?
Yeah.
Then what you could do, here's a thought bubble for you. Maybe what you do is you take the money that is coming out, that is in the 403B, and instead of claiming Social Security at 67, presuming you're in good health, maybe you pull some money out of the 403B to live on, and you use that money. You pay the tax that's due on it because you're going to have to pay the tax no matter what, right? You wait you pull the money out over 3, maybe not all in huge chunks, but if you put it, let's say you pulled out $30,000 a year for few years, for age 67, 68, 69. And then the year that you turn 70, you claim your Social Security, you'll get a higher benefit for Social Security, which is indexed for inflation. So that is good for you. And you will have pulled out some of the money that is necessary, and you'll make those required minimum distributions by the time you get 70 to be 75. It'll be a lower amount of money. We'll get back to Mike in just a minute. If you've got a question, just go to JillOnMoney.com, click the Contact Us button in the upper right-hand corner, write us a note, and if you'd like to join us live, check the box. Mark will do everything else. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
Welcome back. It's the Jill on Money Show. We are trying to help you navigate whatever financial journey you are ready to take. If you have a question, just go to our website, jillonmoney.com, click the Contact Us button, write us a note, and if you'd like to join us live, just check the box marked as everything else. And while you're on the website, check out our subscription service. It's called Jill on Money Live. That's where you have access to quarterly live webinars, the entire back catalog of those webinars, as well as bonus audio and video content. It'll cost you $45 for the next 12 months, but I think it's worth it. It may be worth it for our next upcoming webinar alone, which is all devoted to estate planning. We're going to hold your hands, gang. We're going to bring you through the entire process. We're going to tell you about the pitfalls of signing over houses to kids. We're also going to focus on how you can cajole your parents to actually draft these important documents. It's going to make your life a lot easier. Okay, that's Jill on Money Live. Right now, let's get back to Mike from Chicago and his retirement game plan.
I am in relatively good health, but I was diagnosed about a year and a half ago with a very manageable, slow-moving blood cancer. If there's such a thing, it's the best kind to get. It's manageable with non-chemotherapy. I'm not in any kind of pain. And it looks like if things stay that way, I could live a relatively normal life with just a couple extra blood tests.
Okay. But you're saying that could change your life expectancy. In other words, I'm sitting here saying, hey, he sounds like a healthy, great guy, blah, blah, blah. You're like, well, maybe I'm not going to live till I'm, 85 years old. Maybe I
don't know. My parents, both my parents are alive. It's in their mid 80s. The doctor says that you should die with this, not from this, but you never know. I mean, none of us ever know. But
okay. But if you feel that way, if you'd rather just take the money at 67, that's fine. I don't want you to worry about it. I really don't. But I do think getting some of the money out, the pre-tax money, the money that has not yet been taxed yet, that I think it's worthwhile that you start pulling some of it out, not convert it, but just pulling some out a little bit at a time. And so that you're not whacked with 75 with minimum required distributions.
What is the minimum required distribution? Like, is it a certain percentage?
It's a funny thing. It's based on your life expectancy. Okay. And so it means that, the government looks at you and just think about this, like whatever the money is that's in that account, let's say at age 75. So pretend you had $200,000. It's about 4% starting off. Like 4% of that money has to come out. And then the numbers get bigger and bigger. The percentages go up because the government basically is saying, we want to get paid our money, right? We want to get paid the amount of money that has not yet been taxed. Yeah, exactly. And so it's not like terrible. It's just that, it's the amount of money you have to pull out. So if you can pull some of the money out a little bit at a time, even if it's like $5,000 a year and you pay the tax on, that's fine. You're going to be you're not going to be in a high tax bracket, but you're going to have taxable income, right? And so you'll be somewhere, between 12 and 24%, depending on, how much money is getting pulled, and you'll be fine. You pay the tax that's due. What's the big deal? You know what I mean?
Right. In terms of the money I have in the 403B and the Roth, I got them right now. I have them in very low expense ratio index funds.
Perfect.
And that's what I like because they're easy to manage. And I think that they cover a lot of the bases.
Totally. You don't need, I think people really overthink the investment side. I know that sounds crazy as somebody who comes from the world of investing. I had that life, but I think that all of the machinations around, I can beat the market. I think I'm going to watch blankety blank TV show, or I have a trading system, or that. I don't think it's worth anybody's time, because what we learn over the long term is that most people don't beat the market. Most people just meet the market. And if you keep your expenses down and you don't mess around with the portfolio too much, you should be fine. You should be absolutely fine. I think it's the people who are like, I'm going to try to beat the market instead of save more. That I think is a waste of time. You've done a perfect job. You live within your means. You don't have any. You did say that you had a car loan. How much was that car loan interest rate?
The interest rate, it's a lease, and I
okay.
I release them every 3 years. I like having a new car with no expenses.
Okay, that's fine. That's fine. I thought you had a car loan, but that's fine.
At some point, either this time or next time, I'm gonna probably purchase it out, because then I don't want to have. I like not have the 270 payment in retirement, because I know that I'm going to have to probably get a supplementary insurance policy for health in addition to Medicare.
Yeah,
and I know that's going to be a chunk of money. So I'm looking not to have that 270 when I'm 67.
I think you're in really good shape. I get that, and everyone listening, that I think that what Mike raises this issue of like, hey, a lot of us have diagnoses that would change the question about waiting for Social Security. So we talk about this on an individual basis. That's what I'd like to hear from you. But Mike, I think you're in very good shape. When you get closer to retirement, because it sounds, we'll hopefully be around here, and if we can see what the idea for a condo may look like for you, maybe you'll be able to move up, and maybe interest rates will be really low, and it'll be smart to have a small mortgage. Who knows? But for right now, I think you're in very, very good shape, and I like the game plan. You're on it, man.
That's terrific to hear. I really appreciate that.
If you need some help in developing a game plan for whatever it is you wish to accomplish, Mark and I are here for you. Just go to the website, JillOnMoney.com, and click the Contact Us button. If you want to join us live, just check the box. Mark will do everything else. You're listening to the Jill on Money Show. Welcome back. It's Jill on Money, where we are attempting to take the mystery out of your financial life. And sometimes it is quite mysterious. All these new things come down the pike all the time, whether it's change in legislation, but maybe it's a change in your own life. If there is something going on, or you want to understand how the events of the day or any changes in tax law impact you, get in touch with us. Go to JillOnMoney.com. That's our website, JillOnMoney.com. Click the Contact Us button, which is in the upper right-hand corner, no matter where you navigate on the site, and write us a note. If you think that that is it, you just want us to get an email, then make sure you have a lot of information in there. But if you want to join us live, just check the box. Mark will do everything else. Let us conclude the program with an email from Andrew, who writes, when my nieces and nephews were born, I opened up an UTMA account for them, and I deposited $50 a month. After 13 years, I have a new nephew coming, and I was wondering, with the new 529 rules, would it be better to open up a 529 or an UTMA for this new nephew? Andrew, I am a huge fan of the 529 plan. The real reason being that the tax efficiency is just not to be beat. Meaning when you put money into the plan, it grows without any taxation. But when you pull the money out for qualified education expenses, there's no money due to pay for the capital gains and the accumulation. So that's really great. What you're talking about is the new rule about 529 plan funds that are unused. So presuming you have an account open for 15 years, you will be able to take up to $35,000 and redirect it from the 529 plan into a Roth IRA for the beneficiary. You will be limited to the Roth IRA limit each year, but up to $35,000. Wow, that is a powerful benefit. So that definitely tips the scales in favor of the 529 plan. Well, okay, that is it. That is our program. Our music is composed by Joel Goodman. Mark Talercio is our executive producer, and Webb King. Try to do something nice for someone else today. Change your work, change your wealth, change your life. Thank you for listening. We'll talk to you next week.